The stock market and exchanges. The ability of the stock market to raise capital benefits both individuals and businesses. To raise capital, stock market investors purchase ownership stakes in companies. Equity investments are commonly referred to as the purchase of stocks. Companies can raise capital without incurring debt by selling stock on exchanges. In order to sell stock to the public, in the U.S., companies must disclose information to the Security and Exchange Commission or SEC, a branch of the federal government, and give shareholders the rights to dictate how to run the companies. Selling stocks to the public has its advantage. Corporations use the money raised to expand their business. In turn, the value of their stock increases due to increase in revenue or sales. And as a result, the corporation provides dividends to shareholders and capital gains. The stock market has historically yielded about 10% annually, making it one of the most consistent ways to grow your money. The stock exchange is not the same as the stock market. It is critical to recognize that the stock exchange is made up of the Nasdaq, the New York Stock Exchange, and other over-the-counter exchanges. On the other hand, the stock market is made up of hundreds of publicly traded companies. The stock market includes equity stocks, mutual funds, and ETFs. This is the place investors go to buy shares of companies' stocks or to buy a piece of company's equity. There are also subsets of the stock market, which are indexes. Indexes are collections of companies that represent a specific industry or market segment. Investors normally describe the U.S. stock market by referring to the three major indexes, which are the Dow Jones Industrial Average. This is made up of 30 blue-chip industrial stocks from the United States. Another index is the Nasdaq Composite Index. The stocks in this index are mostly from the technological sector. The buying and selling are electronic. It is composed of over 3,000 companies. The New York Stock Composite Index measures the price movements of all the New York Stock Exchange-listed common stocks. It also measures real estate trust investments. One popular index is the S&P 500. It is made up of the 500 largest corporations in the United States. Stocks and other securities are traded on the stock exchange. Other financial assets have their own markets, like the bond market and over-the-counter markets or OTC. Over-the-counter trading refers to trading that occurs outside of the major stock exchanges. Over-the-counter trades are conducted by sellers and buyers with or without pricing disclosure. Most bonds and stocks, including penny stocks, are traded on the open market with little regulatory barriers. Commodity exchanges are markets for buying and selling commodities. Commodity markets are where raw materials, for example, steel, coal, soybeans, corn and oil are traded. Around 50 major commodity exchanges trade a wide range of goods around the world. Commodity markets trades a subset of assets called derivatives. Derivatives, like options, futures, and foreign exchange market or forex, are financial contracts that are based on an underlying asset. Specific securities values like stocks or commodities are bet on whether they will rise or fall. Derivatives, on the other hand, can be a very risky way for new investors to hedge their bets. Currency exchange markets or forex trading, global currency exchange market. They profit from currency fluctuations. This is good for global trade. Cryptocurrency exchange platform is a type of digital currency exchange market as well. It is a decentralized digital platform that has blockchain-based cryptography, for example, Bitcoin and Ethereum. Cryptocurrencies are traded in specialized cryptocurrency exchanges. In order to make money in these markets, either the stock market, bond market or over-the-counter market, you must purchase something cheap and resell it at a higher price, for a capital gain profit. A capital gain is a profit made on an investment you sold. Selling assets for a profit is one way to make money investing. Or you can hold down to your investments and receive dividends or interests on them. When the value of an investment rises from purchase price and sale price, this is called appreciation. This is like the equity in your house. Investing pays off when you buy and hold assets that generate both income and capital gains. Investing in assets that generate cash flow is the primary objective of an income investor. Some dividend investors buy and hold stocks to earn dividends. Stocks, bonds, commodities, and real estate are the most common types of investing assets. But cryptocurrencies like Bitcoin and Ethereum are becoming a very popular type of investment. Mutual funds and exchange-traded funds invest in variety of asset, bonds, real estate, and commodities combinations. Therefore, they are called funds. Mutua funds and ETFs are diversified portfolios. So, when you buy a mutual funds, index funds, or ETFs, you might be buying stocks, bonds, real estate, and perhaps commodities as well. It just depends on the type of fund you invest in. Even though the stock market has provided an average return of 10% over year, individual stocks are riskier than other types of investments, because there is no guarantee of return or profit. In addition, individual companies can fail or go bankrupt. Companies also raise money by selling bonds to investors. When a company or country needs to raise capital, bonds are issued and sell to investors. The issuer is the company that sells bonds, and the investors are the people who buys them. The issuer will pay you back the principal money you lend to the company, and a fixed rate of interest income, either every 6 months or annually. Bonds are known as fixed income investments because of their guaranteed returns. For the most part, bonds are less risky than stocks. But the risk with bonds is that, since the income or interest rate is fixed, they lose their value when interest rates go up. Also, corporate bonds are also risky because a company can get a low credit rating, and this could increase the likelihood of payment default and bankruptcy. But to reduce losses, one thing you can do is to purchase U.S. government treasury bonds instead of corporate bonds. Now let's talk about commodities. A weak dollar due to inflation may increase demand for a commodity such as gold, silver, agriculture products, energy, and precious metals. Market demand determines the value of these assets. Prices increase as a result of scarcity and demand for these commodities. Normally, when inflation is high, the value of the fiat dollar or currencies goes down, but the value of commodities go up. So, in order to safeguard from inflation, and your money losing value, invest in commodities like gold and silver. You can invest in commodities through futures and options exchange markets. A financial broker can help you invest in commodities. Commodities are frequently viewed as high-risk investments. Borrowing money to invest in futures and options is a common practice that increases risk. So, it is best to have some experience in investing commodities before putting your money out there. Consider a real estate investment trust if you want to invest in real estate but not want to own or manage properties. Real estate investment trusts invest in real estate to generate income for their shareholders. Historically, they have paid out more dividends than other investments such as stocks. Words of caution: investing entails a degree of risk. Increasing your risk increases your chances of profit, but it also increases your chances of losing. Less risk means lower earnings but a more secure investment. Higher risk tolerance indicates that you are willing to accept greater short-term volatility in exchange for higher long-term returns. Do not be too much of a risk taker or too much of a risk-averse investor. But in the long term, you can gain the market. You can gain the market by diversifying your investments. Like they say, don't put all your eggs in one basket. When the stock market performs well and continues to grow, the bond market decreases. And vice versa. Diversify your investment portfolio with stocks, bonds, real estate, and commodity such as gold to hedge or reduce losses. Diversifying your investments across firms and asset classes can help you offset losses as well. Investments can be made with little money. You can open an online brokerage account, if you prefer to do your own research and pick your own investments. And exchange-traded funds or ETFs can assist new investors in diversifying their portfolios. For a hands-off approach, contact a financial advisor. Your relationship with a financial advisor will be based on trust and an understanding of your goals and objectives. Investing consistently over time yields the best results, regardless of how you begin. This entails sticking to a plan regardless of what the market says. Begin investing right away and continue to invest on a regular basis. The most successful investors make money in a systematic way, such as through payroll deductions at work or automated savings from bank accounts. Investing on a regular basis can help you profit from normal market fluctuations. Dollar cost averaging. This works if you invest during a market downturn. Because when the stock market or any other market is down, the stocks or commodities are cheap. So that is the best time to buy low and then sell high. So, when the market goes back up, you should continue to invest moderately because of dollar cost averaging. Overall, your total cost of your investment portfolio will average out over time. While no investment can guarantee a profit, taking calculated risks can result in a high return over time. Many significant stock market gains have occurred following days of significant losses. So, start investing now. Learn about the different retirement accounts and taxable brokerage fund accounts. The internet has a ton of information regarding how to invest. It's time to put your money to work for your future and financial freedom. So, subscribe and like this video. Thank you, and I will see you in the next video.